Hi.
I want to start by asking you, Courtney Donahue, my colleague in New York, just mentioning Rick Mishkin's paper this morning, where he basically says policymakers should avoid setting policy according to swings in the housing market. Do you agree with that view?
No. I thought Governor Rick Mishkin was the only actual governor who spoke so far at this conference. And I thought he was very clear that the Fed should ignore the housing market or speculative bubbles in general in setting. But I didn't get that from the audience. We had 34 different central banks here, and I heard a lot of people discussing it. My sense is that there's more, this is what I think has changed. I think there is more of a feeling that the central banks of the world should have leaned against this housing bubble a few years ago.
In other words,
by raising rates.
Right. Okay.
What they'll do next, that's what we all want to know. That wasn't so clear. I think this is a wonderful conference in terms of its timeliness of the topic. But my criticism of this conference is that there was too much focusing on what we should have done. And I want to know, what are we going to do? We have a crisis developing, and I'm worried about the future.
Okay. What is the crisis that's developing?
The crisis is that home prices have had the biggest boom in world history, U.S., but also Europe, Asia, and other places. And in the U.S., at least, home prices have been falling. And we don't know what they'll do, but there's a real chance that they will go down substantially, and that's going to harm balance sheets. It's going to have all kinds of repercussions, like the subprime crisis that we've already seen, but more of the same. And I would have thought that at this meeting, there were a few people who pointed this out, but it wasn't as central to the discussion as I think it should be. Maybe it's because they have all these professors and academics here who think about the past too much.
But if the Fed starts cutting rates now, and a lot of people think they will, some of the papers presented here seem to suggest the conclusion is that once you get a down cycle in the housing market, prices can only adjust downward so far. Volume has to adjust. You're just going to have a shift, and there's a big inventory overhang, and that's what's eventually going to have to be, kind of let off for this market to stabilize. What difference are interest rate cuts going to make to that?
Yeah, well, this was, I thought one of the most interesting papers was Ed Lemer's, who pointed out that historically, the housing cycle has been fundamental to the business cycle. And every recession, essentially every recession since 1950, has shown a decline in home prices, in home construction. And that's exactly what we're seeing right now. So if you look at these data, it looks like we're at risk of a recession. And then cutting rates, if it's like the past, it will eventually cure the recession, but we might have some rough times for a while.
I want to ask you about the futures market and your price index, home price index. What is that telling us now? And I understand you're getting ready to kind of take another step with it.
Right. In May of 2006, the Chicago Mercantile Exchange, working with my colleagues at Macro Markets and S&P, launched the world's first successful futures market for single-family homes. And that market is more efficient, and it will eventually guide the cash market, that is the market for our homes that we buy and sell. But the volume hasn't been there, and the liquidity hasn't been there. So we're taking the step of extending the horizon to 5 years of the contracts in September 17. And we believe we will eventually have a real liquid market for single-family home prices.
Boy, and that could make a big difference in
this market. It will change the whole market, change everything.
Okay. Bob Shiller, thanks.